Think you're an above-average investor? Here's a sobering reality check. In study after study, roughly 75% of investors rate their skills as above average, which is, of course, mathematically impossible. This overconfidence isn't just a harmless quirk of human psychology. It's costing male investors in particular billions in lost returns. The data is striking. Men trade 45% more frequently than women, and all that extra trading reduces their net returns by nearly a full percentage point per year compared to their female counterparts. Behavioral economists call this the overconfidence effect, our tendency to overestimate both our abilities and the precision of our knowledge. It's particularly pronounced in domains where we have some expertise. The more you know about markets, the more likely you are to fall into what psychologists call the expert trap. Consider this. Professional money managers, despite their deep market knowledge, consistently fail to beat simple index funds. Yet studies show they maintain extraordinarily high confidence in their ability to pick winning stocks. The same pattern appears in retail investors. The more financial education someone has, the more they tend to trade, and the worse their returns become. Why does this happen? Our brains are wired to create stories that explain market movements, to find patterns in randomness, and to remember our successes while discounting our failures. When we make a winning trade, we attribute it to our skill. When we lose money, we blame external factors. This selective memory creates an illusion of control that simply doesn't match reality. The financial cost of this overconfidence is staggering. Beyond the direct costs of excessive trading, commissions, taxes, and bid-ask spreads, overconfident investors typically hold under-diversified portfolios, ignore market fundamentals, and fail to learn from their mistakes. One study of 35,000 household brokerage accounts found that the most active traders earned annual returns nearly 7% lower than the market average. So how do we combat this expensive cognitive bias? The key is to create systems that remove ego from the equation. Start by keeping a detailed decision journal for every significant investment move you make. Write down not just what you're buying or selling, but why. And most importantly, what specific evidence would prove your thesis wrong? Second, before any major investment decision, conduct what psychologists call a pre-mortem. Imagine it's 1 year in the future, and your investment has failed completely. Write down all the potential reasons why. This simple exercise helps pierce the bubble of overconfidence and forces you to confront blind spots in your analysis. Finally, consider whether you really need to be making active investment decisions at all. The data is clear. For most investors, a low-cost, globally diversified index fund will outperform active management over the long term. There's no shame in accepting that markets are smarter than any individual investor. The research we've discussed comes from behavioral economics and psychology studies, examining how cognitive biases affect financial decision-making. While these findings are well documented, remember that this is educational content, not personal financial advice. For decisions affecting your portfolio, always consult a qualified financial professional who can account for your specific circumstances. Mind over money. Understanding why you make the decisions you do is the first step to making better ones. Follow the channel for more.